I'm Tom, head of the Recessionist channel, and I need to talk to you about Iran. Not because I want a war, because the market isn't pricing one in, and if it happens, your portfolio isn't ready. Why should you trust me on this? Because I've been right. I called Bitcoin risk at 100 out of 100 when it was at 94K. It dropped to 65K to the rise. That's a 31% crash exactly when I warned about it. I called the jobs numbers being fake in November. The government just admitted they overcounted by 800,000, the biggest revision since the financial crisis. I went defensive in January when everyone else was buying the dip. My model portfolio beat the S&P 500 by 2% with significantly less downside risk. Those weren't lucky guesses. Those were data-driven calls from a recession scoring model that tracks 18 economic indicators: employment, inflation, yield curves, consumer spending, corporate earnings, all weighted and scored in real time. If you're new here, I don't do financial entertainment. I don't do hopium. I track the math behind economic cycles, and my calls have been right when it mattered. Today, the model reads 64 out of 100, pre-recession territory. That's up from 58 just last month. And the question everyone's asking is, will an Iran war in 2026 cause a recession? The answer is worse than that. It could cause stagflation. Here's what the financial media is telling you. Iran tensions are a defense stock story. Maybe oil goes up a bit, but the economy is resilient. Consumer spending is strong. The Fed can handle it. They're telling you to buy Lockheed Martin and maybe hedge with some energy ETFs. That's not analysis. That's wishful thinking wrapped in stock picks. Because they're ignoring the math, they're ignoring history, and they're ignoring that this economy was already showing major stress fractures before Iran became a headline. CNBC had a segment yesterday called Iran Risk Overblown. The guest analyst said oil would need to hit $100 to matter. That shows a fundamental misunderstanding of how oil shocks work. They don't need to hit crisis levels to break things. They just need to spike fast enough to catch an already vulnerable economy off guard. So let me show you what actually happens when Middle East conflicts meet economic weakness. Because this pattern has played out before, and it never ends well. Here's what you need to understand about oil shocks and recessions. 7 of the last 10 recessions were triggered by or coincided with Middle East conflicts and oil price spikes, not contributed to. Triggered, let me walk you through this. 1973, Arab oil embargo in response to the Yom Kippur War. Oil tripled from $3 to $12 per barrel. The U.S. was in recession within 6 months. Unemployment hit 9%. GDP contracted 3.2%. 1979, Iranian Revolution disrupts global oil supply. Oil doubled from $15 to $39. By 1980, the economy was in recession again. Interest rates hit 20% as the Fed fought oil-driven inflation. 1990, Gulf War buildup as Iraq invades Kuwait. Oil spiked 70% in 3 months. The economy was in recession before the first bomb dropped. 2008, this one's interesting. Oil hit $147 in July before Lehman Brothers collapsed in September. Most people think housing caused that recession, but the oil spike lit the fuse. It crushed consumer spending just as the credit system was getting fragile. Here's the mechanic that most people miss. Oil isn't just what you put in your car. It's an input cost for everything. Shipping costs that affects every product on every shelf. Manufacturing. Petrochemicals are in plastics, fertilizers, pharmaceuticals, food production, tractors, trucks, processing plants all run on oil. When oil spikes, inflation spikes with it across the entire supply chain. And this is where Iran becomes the perfect storm. 20% of the world's oil passes through the Strait of Hormuz every day. That's 20 million barrels. Saudi Arabia, UAE, Kuwait, Iraq, all their exports go through that narrow waterway. Iran knows this. That's why they keep threatening to close it. They don't need to actually block it. Just the credible threat sends oil prices through the roof. If they actually do it, or if Israel hits Iranian oil facilities, oil goes to $120 minimum. Some analysts are saying $150 minimum. Some analysts are saying $150. Now here's the part that breaks everything. The Fed is already cutting rates with inflation expectations at 2.4%. Core PCE inflation is still above their 2% target. They're cutting because growth is slowing, but they're doing it with inflation still elevated. Add an oil shock on top of that and you get stagflation. Rising prices with falling growth, the worst of both worlds. They can't cut rates more aggressively. That feeds inflation and weakens the dollar, making oil even more expensive. They can't hike rates. That kills growth immediately and triggers a debt crisis. They're completely stuck. That's the textbook definition of an economic policy trap. But here's what makes 2026 different from 1973 or 1979. Those oil shocks hit economies that were growing. This isn't an oil shock hitting a healthy economy. This is a black swan event landing on an economy that was already showing major cracks. The Model I track flagged this vulnerability months ago. Jobs were overcounted by 800,000. The Bureau of Labor Statistics just admitted that. That's not a small revision. That's nearly a year of fake job creation. Consumer spending growth has slowed to 1.8%, the weakest since 2020. The 3-month average for job creation is 73,000. Normal is 200,000. We're at stall speed. Credit card delinquencies are at 3.1%, the highest since 2012. Auto loan defaults are spiking. Commercial real estate is a disaster. Office building values are down 35% in major cities. The economy was weak before Iran became front-page news. An oil shock doesn't create recession conditions, it reveals them. And here's what doesn't make sense. The VIX is at 21. That's calm. Not panicked, just normal market anxiety. If investors were actually worried about Iran, volatility would be spiking. Oil is at $70. That's elevated from the $60 range we saw last year, but it's not crisis levels. The S&P 500 is trading within 3% of all-time highs. Everything looks normal on the surface. But dig deeper and the contradictions are everywhere. The Economic Policy Uncertainty Index, that tracks news mentions of policy uncertainty, is flashing red at levels we haven't seen since 2020. Military deployments to the Middle East are escalating every week. Iran just threatened to close the Strait of Hormuz if attacked. Israel is talking about preemptive strikes on nuclear facilities. My recession model moved up 6 points in just 2 weeks. That's the fastest increase I've tracked since March 2020. Corporate earnings guidance for Q2 is getting revised down. Companies are citing geopolitical uncertainty in their outlooks. That's code for, we don't know what's coming, but it doesn't look good. Markets are saying everything's fine. The economic data is saying something's building. Military analysts are saying this escalates or de-escalates in the next 60 days. All of those can't be true simultaneously. And here's the thing about geopolitical risk that makes it so dangerous. It's binary. Nothing happens for weeks. Politicians make speeches. Diplomats have meetings. Markets get comfortable with the status quo. Then everything happens in one weekend. By the time the VIX catches up to reality, you've already lost 15%, and oil is limit up. So, what does this mean for your money? If you're fully invested in the S&P 500, you're making a bet that this stays contained. Maybe it does. But look at the risk-reward math. If nothing happens and tensions cool down, you gain maybe 5 and 8% for the rest of the year. If the Strait of Hormuz gets blocked, you lose 20% in 2 weeks. That's terrible risk-reward. If you're heavy in tech stocks, remember that oil shocks kill discretionary spending first. When gas hits $5 or $6 per gallon, people don't upgrade their phones. They don't buy new laptops. They cut subscription services. Apple, Microsoft, Google, they all get hit when consumer spending contracts. If you're counting on Fed rate cuts to save your bond portfolio, an oil-driven inflation spike kills that narrative immediately. The Fed can't cut rates aggressively if core inflation jumps back above 3%. Your safe intermediate-term bonds lose value at exactly the wrong time. If you're in small caps thinking you're avoiding international risk, small companies get crushed by energy cost spikes. They don't have the pricing power that large companies do. The Russell 2000 typically falls harder than the S&P during oil shocks. Real estate investment trusts, commercial REITs are already struggling. Residential REITs get hit when mortgage rates spike, which happens when inflation expectations rise. And look, I want to be clear about something. Nobody wants this. Wars aren't investment opportunities. They're human tragedies. People's lives are at stake. Military personnel, civilians, families torn apart by conflict. But pretending the economic risk doesn't exist because it's uncomfortable to think about, that's not protecting anyone. That's just leaving yourself financially exposed when you can least afford it. The best way to handle geopolitical risk is to acknowledge it exists and position accordingly. Bottom line, the model reads 64 out of 100. Pre-recession territory and rising. Iran represents a black swan event landing on an already fragile economy. Oil shocks have triggered or accelerated 7 of the last 10 recessions. This time won't be different just because we don't want it to be. I remain defensively positioned. The model says stay cautious until we get clarity. My current allocation, 30% cash and cash equivalents, 25% IEF intermediate term treasuries, 15% gold exposure through GLD and some physical holdings, 20% defensive sectors like utilities and consumer staples, and 10% in energy as a hedge. I'm personally extending duration with EDV. That's the Vanguard Extended Duration Treasury ETF. It's down about 8% right now because of inflation fears and rate uncertainty. But when this recession hits hard, long-term rates will crash and EDV will skyrocket 20 to 30%. The key is having the stomach to hold it through the volatility. All this is tracked live at recessionistpro.com. The full model, all 18 indicators, the scoring methodology, portfolio updates in real time. No black box. Full transparency on how the math works. Here's what I'm watching over the next 30 days. First, oil prices. If Brent crude breaks above $80 and holds, stagflation risk is confirming and the model likely moves to 70 or higher. Second, the March CPI report drops April 10th. If core inflation comes in above 2.8%, the Fed rate cut narrative is completely dead and we're looking at policy paralysis. Third, watch credit spreads. Investment-grade corporate bonds versus treasuries. When geopolitical risk turns into economic risk, credit spreads blow out first. They're at 0.9% now. If they hit 1.2%, recession probability jumps significantly. The window for positioning defensively is closing. Once oil spikes, volatility explodes and credit spreads widen. It's too late to adjust without taking major losses. If this analysis gave you something the financial news didn't, if it connected dots they're ignoring, hit that subscribe button. Stay sharp. Don't ignore the choke point.